Now let's welcome in Nancy Tengler, Chief Investment Officer at Laffer Tengler Investments. Thanks for being with us. Just finished talking to Kevin about this NASDAQ new high. Where do you see it going? Are there corrections in sight? How are we feeling about what we're seeing in the market?
Well, so good to see you. So we've been expecting a correction for some time, and we haven't really gotten one for the market, but we have in various sectors. And when we saw the correction in technology earlier this year, we began to reallocate some of the old value names in our portfolio into growth at a reasonable price technology. And the reason for that was that we expect growth to slow next year. It's not a landmark prediction. It's just based on the math. And so when we get slower growth, investors tend to move toward growthier names and be willing to pay up for them. Add to that, the narrative is very supportive of tech for some time and is also, I think, critical to this market continuing to move. And by that, I mean investing in tech infrastructure, now above 50% of total infrastructure spend, will continue to drive productivity as we experience wage price inflation and higher input costs. So we think technology is an area where you do want exposure, growth at a reasonable price, not growth at any price.
Okay. So GARP, right? Growth at a reasonable price. Tell me about the second half of the year here, though. You really do like these growth stocks, particularly some dividend growers. Tell us more about that and how people can go about trying to find these names.
Sure. So growth will be strong in the second half of this year. We have, new orders are much higher than production. We saw that in the PMIs. That's largely driven inventories to historic lows. And so you will see inventory replenishment, and that will, again, be good for the overall economy. It'll be good for stock earnings, CEO confidence at historic highs, and plenty of cash that they've either got on the balance sheet or unused credit. So M&A activity should increase. We should see, continued investments in CapEx. And so I think what you want to do as an investor is you want to look for names that are going to benefit from that. So what are the sort of sustainable themes? Cybersecurity, cloud. We know now that chips, there's still a chip cycle, but we use so many more chips in so many more aspects of our life that the cycles are probably going to be a little bit more muted. And then looking for dividend growers, because company managements in companies that pay a dividend set the dividend as a portion of long-term sustainable earnings power. We've seen incredible increases this year in dividends announced by companies. And so those are the ones you want to look for, and start with the dividend aristocrats and look at some of those names if you're having a hard time identifying names.
Okay. And that being said, when you look at the big picture, I know we're waiting on the important jobs report tomorrow. And tell me what you think, how the market could react one way or the other. Of course, the big focal point this year has been all about the Fed and the decisions that they're making on inflation and how it affects the rates and the yields. So when you put all of this together, can you give me some thoughts, some big picture thoughts?
Yeah, so on the jobs report, I think the really important jobs reports are going to come once the supplemental benefits go away, if they do go away. And that's because we know we have huge demand for jobs. The JOLTS is above 9 million. And eventually we'll get a supply of workers when those benefits come off the rolls. We've already seen it in Arizona, which ceased the supplemental benefits on July 10th. And you can see in the states that have done that, continuing claims have gone down dramatically relative to states that have not ceased the supplemental benefits. So I think you want to watch, there's going to be volatility in the near-term job numbers. I'm not going to do anything on the other side of that, sorry. But I think that you want to be focused on that. And then I think the Fed has been a little too sanguine on how much they can control inflation. So we've been adding to some of the names that will benefit from continued inflation. We've added to materials. We've put in place a strategy that focuses on the industrial metals that drive planetary decarbonization, because we know that's a sustainable theme. So you might want to look at some of those names. And then in terms of overall corporate earnings, we think it's going to continue to be blockbuster and stunningly good. Most of our companies that have reported already had triple plays, which is a beat, and a raise. And so, we think that's pretty exciting. And then you've got the confidence from the CEOs, and we'll start to see job applicants returning.
Yeah, you talk about the Fed. the Fed, I mean, at this point now, what do you think they should be doing, and when?
Yeah, I think they should have started to taper already. They have a laser focus on the jobs market, but the jobs market is being held down, or the unemployment rate is being held up by these supplemental benefits. So there's little they can do until people are going to be forced to go back to work. So I think that's an issue. And then one wonders if they can ever really raise rates much with all the debt that DC is piling onto the balance sheet. So I think, we're worried about a policy mistake from Washington. This $3.5 trillion reconciliation bill, as proposed, we think would be disastrous for various reasons: tax increases, increased spending, which will drive inflation further. And so we're watching that very closely and hoping that cooler heads will prevail and that we'll see a more reasonable approach to what the Biden administration is calling the human infrastructure bill.